On November 2, 2022, the price of Bitcoin plunged 30% in a single day, and at the same moment the world learned that Sam Bankman-Fried, the self-styled crypto Robin Hood, had allegedly siphoned more than $8 billion from the very customers who trusted his empire, FTX. The shock reverberated through every corner of the financial universe, turning a once celebrated visionary into the centerpiece of the largest fraud ever witnessed in digital currency. Born in 1992 to a family of academics, Sam Bankman-Fried, known to friends as SBF, grew up in the quiet suburbs of Cambridge, Massachusetts. A prodigy at the Massachusetts Institute of Technology, he graduated with a degree in physics before diving headfirst into the nascent world of cryptocurrency. In 2017, he co-founded Laundering Research, a quantitative trading firm that would become the financial engine behind his later venture. 2 years later, with $15 million raised from a handful of Silicon Valley investors, he launched FTX, a futures exchange promising low fees, sophisticated products, and, most importantly, ethical stewardship of users' funds. The narrative that propelled FTX to a $32 billion valuation was as polished as it was persuasive. SBF appeared on podcasts, conferences, and talk shows, preaching defective altruism, the idea that one could do the most good by maximizing the impact of every dollar. He pledged to donate a substantial portion of his wealth to charitable causes, and he positioned FTX as a safeguard against the excesses of traditional finance. The brand cultivated an aura of transparency, real-time dashboards, open-source code, and a trust by design mantra that resonated with a community hungry for legitimacy after years of scandal. But beneath the glossy veneer, the architecture of FTX was collapsing. Internal documents and whistleblower testimonies later revealed a tangled web of intercompany loans, hidden liabilities, and reckless leverage. Alameda, the trading arm, was allegedly using customer deposits from FTX as collateral for risky bets on illiquid tokens. When the price of the meme coin Pepe crashed in early October 2022, Alameda's balance sheet hemorrhaged, and the shortfall cascaded into the exchange. The tipping point arrived when Binance's CEO, Changpeng Zhao, announced on Twitter that Binance would liquidate its $600 million holding of FTT, the native token of FTX. In a matter of hours, panic spread, withdrawals surged, and the exchange froze, leaving users unable to access billions of dollars of assets. The fallout was swift and dramatic. On November 11, 2022, U.S. authorities announced the arrest of Sam Bankman-Fried in the Bahamas, where he had been living under a self-imposed house arrest. The Department of Justice, the Securities and Exchange Commission, and the Commodity Futures Trading Commission jointly filed charges alleging wire fraud, securities fraud, money laundering, and conspiracy to defraud customers. The indictment painted a picture of a mastermind who deliberately misled investors, concealed the true financial health of his companies, and diverted funds for personal luxuries, political donations, and extravagant parties. The trial, which began in early 2024, unfolded like a high-stakes courtroom drama. Prosecutors presented a mountain of evidence, emails showing SBF's instructions to transfer customer funds to Alameda, internal spreadsheets that listed missing assets, and recorded conversations where he boasted about moving money around to stay ahead of the market. Witnesses from former FTX employees described a culture of intimidation, where dissenting voices were silenced, and the mantra, "We're building a better world," served as a shield for unethical behavior. The defense, meanwhile, argued that the collapse was a cascade of market forces beyond any single individual's control, insisting that SBF had acted in good faith and that the alleged fraud was merely a mismanagement of a rapidly evolving industry. After weeks of testimony, the jury retreated to deliberate. On May 15, 2024, the verdict was read, guilty on all counts. The courtroom erupted with a mixture of shock and vindication. SBF, seated in a black robe, stared blankly at the judges before being led away in handcuffs. The sentencing phase, scheduled for later that year, would determine the length of his imprisonment and the extent of restitution owed to victims. The aftermath rippled far beyond the walls of the courtroom. Regulators worldwide accelerated their efforts to impose stricter oversight on cryptocurrency platforms, demanding proof of reserves, third-party audits, and clearer segregation of customer funds. The U.S. Congress introduced the Digital Asset Transparency Act, aimed at preventing another FTX-style collapse. For the countless investors left holding worthless tokens, the path to recovery has been arduous. A court-appointed receiver is tasked with liquidating remaining assets, an effort projected to return only a fraction of the original $8 billion. In the broader cultural landscape, the FTX saga has become a cautionary tale about hubris in the digital age. Podcasts dissect the ethical paradox of a philanthropist who built his empire on deception. Documentaries explore how the allure of crypto altruism can mask dangerous power concentrations. And amid the wreckage, a new generation of entrepreneurs is emerging, promising greater accountability while still chasing the promise of decentralized finance. Sam Bankman-Fried's rise and fall underscore a timeless truth, that charisma and grand vision cannot replace transparency, sound governance, and the immutable law that no one is above the rules. As the crypto industry rebuilds, the shadow of FTX will linger, reminding every trader, investor, and regulator that the line between innovation and fraud can be as thin as a blockchain's code. Subscribe to The Verdict for more stories like this.